Hi, I'm Sam Newton, founder of Gravitate Accounting, and I'm going to go through the 8 most common questions we get during the proposal stage. So when you come to having a proposal meeting with us, you know some answers before we even get started. So point 1, proposals. One of the most common questions we get is how do you charge for the work? And so you'll see as you go through our proposal process, there is it's a menu of services where you get to select exactly the services that suit to you. We will obviously advise what we think is best because based on our understanding of you and your business and the problems we've heard during the initial chat. And like I say, that will give you a recurring monthly fee. And the other common question that's linked to that as part of this first question is, do we charge one-off fees? So as part of this joining Gravitate, let's assume you're joining halfway through a year. You're obviously 6 months in. Some of those services, for example, the year-end accounts, there's 12 months worth of monthly fees to collect. So we have an alignment fee that happens once, just when you join us, and then won't happen again. And that allows us to catch up for those 6 months of annual fees that we haven't collected as we haven't been acting for you. But anything like the VAT returns or anything like that, obviously we haven't done those services for the last 6 months, so they're not included in the alignment fee. Anything else that's one-off? Well, we really encourage open interaction between our client and our team members. So everything else we'll be chatting, and if there's something that's outside of the scope of work that hasn't been agreed and it's a significant piece of work that we advise you doing, then we would say, look, this isn't covered in your current fee, so what we're going to suggest is a one-off fee of X. And then at that point, you've got the decision. You can either say, look, I see the value in that, I'm going to sign up and have that as a one-off fee, or you're going to say, look, I can do it myself, or I'm going to speak to someone else. We're not fussed either way, but it'll be open and transparent. You're never going to get a bill 2-3 months after doing a piece of work or after picking up the phone to us. It's not how we operate. The second question is a bit more to do with the day-to-day running of a business. So another real common question we get is, how do I pay myself whilst running a limited company? And essentially, the most common ways is a combination of salary, dividends, and then also some potential benefit in kinds. So I'll take you through each one. The salary, we would work with you. Again, we have a payroll team in-house who can set you up the payroll scheme and then operate the payroll scheme for you. The benefit here is we're going to tell you each month, you're going to get a report from us saying, for you and your team, here is the net pay. This is what you need to log onto your bank and pay people, or we have a service where we can automate that process for you, so the payment is made and you would just top up an account and that would be distributed to all your staff. And then also it tells you you've also got a payment due to HMRC regarding pay-as-you-earn and national insurance that's been deducted and what the company owes. All this will be set out in a really simple report for you. And again, with regards to the pay-as-you-earn national insurance payment, we'll work with you and actively encourage you to set up a direct debit because, like I say, the last thing you want to do is miss or get behind on payments to HMRC because they'll quickly charge you interest on that. The next most common way of taking money out of a business is dividends. And again, so we will be working with you. One of the most common things we offer as a bolt-on service to our standard compliance work is a remuneration planning session where we're going to say, understand you as an individual, if you've got any other income elsewhere, your family set up, and then say, okay, let's look at how we can best extract this money from the business for you. And like I say, by doing that, we can quickly confirm whether you're going to go down a salary route or a split of salary and dividend. So if you're going to go down a split of salary and dividend, we would actively encourage you to take one fixed amount each month. The benefit here is you're not using the company bank account like a personal bank account. There's a high level of control because, like I say, as part of the remuneration planning, we could say, okay, I want to take £50,000 off out of the business, so I'm going to take £12,500 of salary and the rest is dividends. So we can calculate that amount for you and then tell you exactly what your personal tax payment is going to be on certain dates in the future. So how dividends work is they are payments made to you gross of any tax. So if you were to take a salary, for example, the chances are if you're earning over £12,500, you're going to get some tax and national insurance deducted. But when it comes to dividends, you're just going to receive that whole amount gross. And then that will be declared on a tax return, which is made up to the 5th of April each year, and the initial payment is due the following January. You do have payments on accounts that interact with that, but again, we support you through that whole process, and that's a real benefit of a remuneration planning exercise, because we can say, if you take this much, your payments in the next January and July are going to be X and Y, and therefore we need you to either keep that money to one side in the business or keep it to one side personally. The third most common way of remunerating yourself is through benefit in kind. A prime example of this is a company car, for example, especially if you're looking at going electric. There is still some significant benefits to having a company car go through the business. The main being, if you're going to lease it, you can recover a proportion of the VAT. If you're going to purchase it outright or lease it, it's tax deductible. The big difference is you're paying, the business is paying for that car, not you taking money out of the business to then pay for it personally, because that's already suffering some tax, whether that's dividend tax or tax based on your income. So what will happen is, again, we would offer to do your P11Ds submissions on your behalf, and we would take control of the whole situation, because you would say to us, look, I'm going to get this car. Okay, we would sign you up for the P11D service, and then once a year we would get to the 5th of April and say, okay, we now know that it's time to submit a P11D. Have you had any other benefits from the business? Have you had things like medical insurance, or have you taken overdrawn money out of the business? So we'll understand all those key points by working with you and looking at your accounts. And then we'll prepare the submission to HMRC, the P11D submission, on your behalf, and just go through that with you and say, look, this is the scenario, this is when you started leasing the car or utilising the car, and this is the tax implications. You'll know full well at the end of that all of the money you've taken out of the business is as tax efficient as possible. And that's just by having really positive conversations between you and ourselves of understanding you and your scenario and how we can best support you. The third most common question we get is, should I be doing the bookkeeping for my company? The key thing about the bookkeeping is it's an integral part of your accounts. If the numbers that are going into the account software are wrong, it's going to cause issues. You're not going to be able to understand how your company is performing. So it's really key that it's right from the start. So we highly recommend using a finance professional to complete the bookkeeping. So if you as a business owner, I think sometimes at the start it is good to get a bit of an understanding of the bookkeeping, the process, and how that impacts your numbers and your performance. But at a certain level, it's not sensible or scalable. My key thinking here is, if you're a business that spends 10% of your time, which is half a day a week, if you worked a 5-day week, doing accounting work, and your business is turning over, I don't know, 100, 200,000 pounds, and that's all down to the work you do, well, even at 100,000 pounds, it's costing you 10,000 pounds of your time to do that. Would it cost us, for that kind of consultancy business, would it cost us £10,000? Probably not. So how much time can we save you by doing this for you? If you have a finance professional in-house, or you have a complex business where there's a lot of interaction between the operations team and the accounts team, I do think generally it is best sat in-house, but a lot of the time we can work with the systems you've got, the team you've got, to extract the information and make the process of bookkeeping really efficient. The benefit there is you have professionals who do this work day in, day out, doing it really efficiently on your behalf. So you know the numbers you're getting are accurate. You can log on to your accounting software, review your P&L, and get a really good understanding of how your company's performing. We can work with you we can take this service to the next level, so we can support with chasing debts and making payments. So really, we enjoy working with business owners who trust us as an arm of their business, and we can say to them, look, we think, based on our knowledge of you and your business, we can take this off you, relieve you of the stresses, allow you to focus on scaling your business, and we can take on large proportions of the work. Like I say, at certain times, we might even say, look, given the interaction between the ops team and you need that person in-house, it's not going to be cost effective to have us there all the time. We can see some real logic in you recruiting, but we'll be open and honest with that throughout our key thing is we want to support our clients, and we'll always act in your best interests. Another common question we get is, how will you help me with my personal tax return? So with us, the personal tax return, you have until January to file a personal tax return, but we'll start talking to you on the 6th of April. So after the 6th of April is the start of a new tax year, and you'll get an email from us within a couple of days saying, this is everything that needs to go on a tax return. Please can you complete that information? Please can you send us the information we require to help us prepare a tax return? And generally speaking, we'll have the salaried income because we'll be doing the payroll for our clients. We'll have the dividend income because we act for your company. But we're trying to get out those extra few pieces of information that we don't generally hold on record. So things like if you've got a rental property, things like if you've got investments that yield dividends and things like that. So we'll be asking for that additional information. So the team that look after you and us as a business, we actively encourage everyone to get our tax returns filed as soon as possible. We really believe from a financial and mental well-being perspective that getting those tax returns submitted quickly allows you to see the tax due and way ahead of the time it's due. So by being proactive in getting that information submitted, it puts you one step ahead and allows you to do that cash flow planning personally for your personal tax returns. Again, we mentioned it before, we do offer this remuneration planning service whereby we will look at the start of the year, we'll be looking at your income plan for the next 12 months, seeing exactly what you need to take out of the business to live the life you want to live. And then we can say, okay, off the back of that information you provided, this is the dividend you need and this is the salary you need. And these are going to be the tax payments that are due in January and July, looking forward for a couple of years. So as long as, obviously these situations change, but we can be proactive and update that. But from a planning perspective, you'll know that if you do take extra, this is going to be the knock-on impact. So overall, from a personal tax return, we're going to be there supporting you from day one. We actively encourage everyone to get those tax returns done as early as possible. We don't want to be getting near the January deadline. For us, or July, August, we filed the P11D, so we know if they need to be included on there. We've got all your other information. If we can get it done in July, there might even be a chance that it changes the payment that's due at the end of July, because generally speaking, payments of personal tax are due at the end of January and the end of July. So changes, the benefits of filing prior to July are if there is changes that impact that July payment in a positive way, i.e. will reduce the payment, we can get that done for you on your behalf. But overall, like I say, we're here to support you. We're here to help you understand the complexity of personal tax, because there certainly are complexities, and we actively encourage conversations and questions, so to help you understand and drive you to that end goal of financial clarity. The next common question we get is, what information will you require from us at year end? And this is a bit of an old school question really, because we're working closely with our clients, they're going to be on an accounting software. Generally speaking, we're interacting monthly or quarterly, so we're going to be getting bank statements quarterly to file VAT returns. We're going to be querying throughout the process, like, or what is this purchase and what's that purchase? So by having these meetings and these regular touch points, really the year-end process should just continue on from the previous quarter. So we'd need a bank for supporting evidence to that. We generally be working with you to get supporting evidence on other balance sheet items, things like stock, but again, we'd be working with you to say, look, let's get an integrated stock system. Let's get one that links to your account software or is within your stock software. So the key thing there is, by working so closely throughout the year, we should be in a great place to get past the year end, and there's not going to be masses of information requested because of the relationship that we built up through the year and the understanding. So it then rolls into, okay, so now it's the end of the year, we've got all this information, let's look at getting these accounts filed as quickly as possible. One thing we typically have as well, which is quite key to the year-end planning, is a pre-year-end tax planning meeting. And so the real benefit of this is 2 or 3 months before the year end, we're sitting down and we're saying, we're 10 months in, your tax bill estimate will be this. If you continue trading like that for the next 2 months, What could we do in those 2 months to reduce that tax bill? So have you got surplus cash? Could you make pension contributions? Are you looking at hiring someone early next year? So in 3 months' time. Well, if you spend that money in 3 months' time, the tax saving is going to be in the following year. But if we can get that money spent in the next 2 months, then we're going to be saving you that tax on the next tax bill. So having proactive conversations like I say, it's always going to be situational. So not everyone wants to invest money in pensions. So it might be more looking at, I don't know, utilising company cars and stuff like that, or purchasing assets to scale the business. But we understand the situation, what your desires are, and then we apply that in that pre-earnings tax planning meeting. So again, that's just another step we take. So when it does come to that year end, we're really ready for it. We've got really good grasp on what the tax bill could have been and the investments we've made during that time to protect that tax position. And then, like I say, we're in a really strong position to get those accounts prepared, turned around, and completed. Again, proactively getting it done early so we know what that tax bill due in 9 months is, and we're not caught filing a set of accounts and a tax return after 8 months and having to find a significant amount of tax within the following month after. So the next most common question we get is what is a director's loan account? And simply put, it's just all the transactions that are between you as an individual and the company. So there's loads of examples. So if I'm talking about putting money into the company, I could be physically paying cash in. That's an example of me and the company interacting, and I'm increasing the balance of my director's loan account because that company owes me that money. Other examples might be if you vote a dividend but don't take that money out. So that company owes you that money. So again, that's increasing that director's loan account. If you say, oh, I'm going to put a salary through, the £12,500, let's say, but I'm not going to actually take the cash out because I don't need the cash out when it's in the business, but I know at some point down the line, then that company, I can take that out. So again, that's another example of increasing that director's loan account. Examples of taking things out could be if you have personal transactions that go through the business that should have actually gone on your personal bank account and not your company account. So let's say you're out with your friends and you accidentally tap the wrong card, that would go to your director's loan account because it shouldn't have been in the business. It's not wholly and exclusively for the purpose of the business. There's no business relevant, so it's going to reduce that balance essentially. And again, other examples are if you're just taking money out of the business, but it's not a salary and it's not a dividend, that's just you taking money out of the business, and that's going to reduce your director's loan account. And so all these transactions through the year will be pluses and minuses, and you'll have a loan account balance at the end of the year. Similar to a bank account, if you've got a positive loan account, i.e. the company owes you money, then you can charge them interest. So you can say, well, actually I should be benefiting from this because I'm giving the company money. So you can charge interest to the company. And interest is taxable as on an individual, but if you've got multiple shareholders, for example, it might make sense that one shareholder's putting in a big chunk of money but not getting any benefit for it. So in that scenario, all the directors are all the shareholders are benefiting, but only one person's putting money in, so they should be paid interest. So again, it's very situational, but it's all solved by having open conversations. Common ways where a director's loan account will be positive will be at the start, people putting in money to get the business started, very common scenario. Or if you invest into scale, so you happen to have personal wealth and you're like, okay, I want to put some money into, I want to take this company to the next level, and I'd rather not get bank lending or other lending. The opposite side to the spectrum is when you take out money, you overdrawn your director's loan account. So that's when you've taken out more than you put in. So common examples of this are when you're taking money out but it's not dividends, or you get in a really bad habit of everything you do, you go to, every time you use a card, you just use your business card and tap, 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 tap. And your accountant says all those costs are not allowable to go for the business, therefore you've got a huge director's loan account and you've got to do something about it. So typically you would either vote a dividend to clear that balance down or take a bonus to clear that balance down. So you would say, my director's loan account's overdrawn, I'm going to vote a dividend of, let's say it's overdrawn by £10,000, I'm going to be taxed on that, but I'm not going to take the money out because I've already had it in the way of hundreds of expenses that added up to £10,000. So that can happen. The risks with going overdrawn on a director's loan account, Well, you have to pay something called beneficial loan interest. So like you could benefit from getting interest income when you have a positive loan account, when you've got an overdrawn loan account, you have to pay beneficial loan interest to HMRC. And that goes on a P11D, and that's for any balances over £10,000. So it's definitely something to be aware of. Another tax you have to pay is called Section 455 tax, and that is basically HMRC's way of saying, well, if you were to take £20,000 out of the business, we would get dividend tax on that. So what we're going to do, we're going to put a holding tax on you. So if that balance is 20k, we're going to tax you, and the rate changes, but let's say it's 33%, so at £20,000, it's £6,600, we're going to charge you Section 455 tax of that amount, and if you reduce that to nil by the following year, then we'll give you that money back. So it's based on the balance, so if you reduced it by half to 10,000, you would get £3,300 back. So as you can see, that balance changes, and the key thing there is that the company is reviewed at its year-end position. So if that balance is £20,000 overdrawn at the year-end and you don't repay it within 9 months and a day, so that's when your corporation tax payment's due, then you have to pay that £6,600. But if you've reduced it in that time, obviously the amount due will also reduce. And again, it's also worth keeping up to date with the current Section 455 tax rate and beneficial loan interest rate. Final question we get asked a lot is, what is a government gateway? So when you sign up for a client of Gravitate Accounting, one of the first things we do is set you up on our government gateway. So we get access as an agent to your government gateway. And if you don't have one, that's why we're helping you get one set up. We think it's really important because you get all your taxes in one place, so you can really understand. You can log on to HMRC's account and say, okay, what from a company perspective and personal perspective, what personal tax do I owe and when's it due? And from a company perspective, what's my pay-as-you-earn due, what's my VAT, what's my corporation tax? And both of them, those are the common taxes, both of them have got numerous other taxes on there. But also, once you've set up, we can get access as agents, and then we can talk to HMRC on your behalf. Because the last thing we want you doing is waiting on hold, like we have to do numerous times a day, trying to contact HMRC. So we try and get that in place from the start, so we can act and talk to HMRC on your behalf to make your life easier. Those are the main questions we get during onboarding. Obviously, as you go through the process of a quote with us, you might have different questions that pop up, so feel free to ask them and we'll be sure to answer them throughout and look to build out this video in future to make it more and more useful as more and more clients join Gravitate.